Hi, Larry Gaines, Power Cycle Trading. Well, we're into the earnings season officially, kind of this week kicking off with the bank stocks primarily. So here's one on JP Morgan. So you can see here JP Morgan's earnings were released today after, on the open before the market opened. So you can see the implied volatility here falls off. So that's very typical. You have this what we call volatility crush. All the uncertain builds up and creates the implied volatility go up, and then after an earnings release, that uncertainty's gone, implied volatility collapses. So with a lot of the bank stocks, some of the better trade setups are to basically sell volatility, sell time. And so there are a number of different strategies, and let me show you one that is designed specifically for something like this, to sell volatility, to sell time, and especially on something that doesn't tend to exceed what we call the expected move. So let's take a look at the stats first. So these are the earnings statistics for JP Morgan. So you can see this goes back, gosh, this is probably 20 or so earnings cycles. Okay, so you can see here the last number of, maybe down to 10 or so, whatever. What I want to point out is not very big moves. So this is the move at expiration based on where it was on the day of its earnings release. So you can see that JP Morgan doesn't tend to move a whole lot. So here's like the biggest move right here, 4.36% up at expiration. So with this type of stock that doesn't have a tendency to move much, what you want to look at are those types of strategies where you sell volatility and sell time, where they don't tend to exceed that expected move range. So here's a trade setup that accomplishes that specific trading goal. So this setup is one where you can sell volatility and sell time. So this is what we call an iron butterfly. So basically what we're doing, we set this one up. This was set up Monday afternoon, so to take effect when JP Morgan announced its earnings this morning. So it was selling the Jan 18, so this is for expiration on Friday. So basically we were going to sell the 100 call, so that was close to the at the money, and then sell the 100 put. So basically you're looking at a straddle, and then you buy a strangle on the outside, or you could look at this as selling a bear call credit spread, the 100-104, then selling the bull put credit spread using the put 196. So balance $4 spread wide, that's your expected range. So set this up with the $2.65 credit, so brought in a lot of credit, so $3 wide spread, so your risk is the difference of $135. So the downside risk is $135 if it was to close below 96. The upside risk is $135 if it was to close above 104. Today it went out right here at 101.68 right there, and so this was up $46 per spread, which is based on your return, your capital at risk 135. That's a 34% return. Now, over the next couple of days, if this was to go out at 100, this thing could make potentially over $240. So you can see it has a really fantastic risk-reward ratio if you get up here in this range. So if we were, let's say, coming into Friday, and it was trading right here, let's say at around $100, this thing would be up about $169. And if you got it perfectly pinned right there, it would be up the full credit of $265. So that's one way to trade an earnings release, and that's on using an iron butterfly.